we are slightly more optimistic on equities. So that's really because of the better economic data that we've seen. So it's really rather global in nature. So China, we've seen the data, it has bounced back quite sharply, and also in Europe and as well as the US. So as a result, we have turned a bit more optimistic, and we're allocating that money into US and Asia ex Japan. And the reason why is because for the US, it's more of a growth style and it has more healthcare in its weight. And we believe that these stocks are going to perform well in the future because we're going to be in a very low interest rates environment, which will be supportive to growth stocks, for instance, like technology. And for Asia ex Japan, there is also quite a big weight in these tech giants in Asia. And also this region is very economically sensitive to the global economy. So we are right in the sense that the economy is heading in the right direction. Asia ex Japan should be a region that should benefit. And we are not as optimistic in Europe. As you can see, it is still quite hard to push things through in that region. And I think that region has fundamentally more of those value styles stocks, which is unlikely to do well in a low interest rates environment.
Yeah, you and I share something in common. That is, longer term down the line, we have concerns about inflation, but it's hard to see it rearing its head in the short term as well. What does that mean our viewers should do for their fixed income positions?
Yeah, so as we have turned slightly more positive on equities, we have, on the other hand, turned even more pessimistic on fixed income. So the reason why is because I think yields are very low. I mean, this doesn't really need to be emphasized, but as in the UK, the gilt yields are at the lowest ever for the 10-year. And we think that there is just a lot of asymmetric risk to the downside in terms of yields. And as you have mentioned, inflation, I mean, I don't think it is a very near-term issue. So technically, the headline inflation should pick up because of the oil price pickup, but we don't think that will be like threatening, as in going above the 2% target or anything like that. But in the slightly longer term, I think this is not being appreciated by markets. Because we have got so much fiscal stimulus as well as monetary stimulus, and this could potentially be more inflationary in the longer term. But I think markets haven't priced that in, so there could be some risk to the yields going up. So as we're long-term investors, we just don't see that much value in government bonds at the moment.